Hey, everybody, welcome back. This week I have on Sam Callahan. Sam, welcome.
Hey, Joe. Thanks for having me back on.
Yeah, glad to have you back on. I think this is going to be a great, timely conversation given, all of the Bitcoin volatility that we've seen and the uncertainty, I guess, in the world. So maybe we can kind of start with looking back at the X piece that you posted recently. Part of the title was "The Price of Uncertainty is Rising." Maybe kind of give like a high level overview of what it is and why you wrote it.
Well, basically, I was just looking for different market divergences, and I kept seeing these like weird divergences happening across the market, and I just thought they all kind of had something in common, and they were kind of saying the same thing, which is that there's more uncertainty. Investors are a little bit more spooked about the future, and they're kind of demanding to get paid more, compensated more for taking on risk. And we can kind of break down the different divergences that I see. But it's really echoing a lot of the comments that we saw from like Ray Dalio, for instance. He went super viral because he shared his like changing world order uh, warnings. And so he was kind of talking about this. If you look at, something like the global uncertainty index, it's just gone straight up. If you look at even the commentary from central banks, like Bank of International Settlements just posted this long report. The very first sentence is periods of heightened uncertainty has become a defining feature of the market and why it's challenging for them. And so, as investors, I think it's important to understand that, how we allocate capital in this environment where there is more uncertainty, it changes things. And we've last 30 years, we've been in this period of relative stability from a geopolitical perspective, from a monetary perspective, from an inflation perspective. Things have really accelerated over the last 6 years. I think people feel it in the air. And this is why I like started out with that JRR token quote. The world has changed. I feel it in the water, feel it in the earth, I smell it in the air. People can feel that things are changing pretty rapidly. And I think when I looked at the data and these certain divergences, you can actually see it. And so that was the purpose of the piece. And I think, when it ties back to Bitcoin, Bitcoin benefits in periods of uncertainty, in my opinion, or it climbs the ladder during periods of chaos, so to speak, because Bitcoin is this alternative asset, this alternative that you could turn to that's outside the system, that doesn't have counterparty risk, that is permissionless, can provide that censorship resistance against capital controls, doesn't have borders, and so I think it actually benefits in this environment. Um, but yeah, I'll stop there. But that was kind of the impetus to write it.
Yeah, I think that's a great overview. And correct me if I'm wrong, but I think you kind of front ran Ray Dalio's piece, and I saw like the uncertainty index. Like I feel like that was after your article, so you're kind of ahead of the game here.
Well, Dalio, to his credit, he's been writing about this for a
Yeah.
while. Some of his books. My favorite book is, I think, the Big Debt Crisis, which is like a really like a thick. It's almost like a huge research report rather than just a book. But he's been warning about this stuff for a long time. I think Dalio has been kind of slow to wake up to why Bitcoin is connected to that thesis. But he has gotten into gold. And I think that's like one of the divergences that I talk about is how gold has been like outshining Bitcoin of late. And it's causing a ton of chatter and concerns and all this. But I really think that's just a function of people like Ray Dalio or people who manage a ton of money, like big institutional pools of capital. They're going to flee to the familiar safe haven, the familiar store of value. It doesn't mean that gold is better than Bitcoin or it just means that in this short period where there's still information asymmetry around Bitcoin, that you could see a period where gold's going to perform really well. And I've always said that, gold. If Bitcoin didn't exist, I'd probably own a ton of gold. But the problem is Bitcoin does exist, and I think it's better technology. But I think Dalio and people have talked about this. We are in this period of shifting um, frameworks and different geopolitical relationships and how the monetary system functions. And we're in it right now. I mean, you're seeing all kinds of what they call like Sigma events, right? That was like the word of the day the last couple of weeks. And you're seeing these, Besant and Warsh talking about a treasury Fed accord. all these like big shifts that happen. And it can be almost dizzying week to week. But that's why I wrote this piece, is just to kind of highlight that we're seeing it across asset classes. Um, yeah.
Yeah, and I tend to agree. Obviously, I mean, I do feel like uncertainty around the world has been rising. I'm curious, like on the time frame that you feel like this is happening. Has this been something that's been happening for like decades? Has it been since 2020? Is it something that's really occurring over the last like 6 months or so? Like, how do you see this? Like, when since when has uncertainty or the costs, the price of rising of uncertainty been rising?
Well, I'd say this has been going on for a while. I mean, people like Luke Groman have been talking about this since, I don't even know, the mid 2010s, about kind of the diversification of reserves away from U.S. treasuries, from foreign entities. And you're seeing a chatter from Russia to China, the BRICS nations, about how the dollar has been weaponized against them and they need to move away from a dollar system. Not only that, but the long term structural damages that occur from having a reserve currency, right? We talk about the Triffin dilemma. We talk about the hollowing out of the middle class and the US's industrial base because of this function of being the reserve currency. And so I think these are like things that have been happening for a long time, but I think things have really accelerated over the last 5 years or so. And I think that's related to the huge fiscal and monetary response from the pandemic, which just blew up the Fed's balance sheet, uh, blew up the debt at a point where there was already concerns, and inflation reared its ugly head in the official CPI numbers for the first time in a long time. And so that caused a lot of uncertainty. And then obviously the sanctions against Russia's FX reserves really woke people up, and you really see that in the data with the central bank gold buying and the different institutional buying of gold. There's real concerns about the sustainability of the U.S. fiscal position, and then the increased weaponization of the dollar. And whenever you have a action, there's an equal and opposite reaction, and we're seeing that really play out over the last 3 years. And so I think what we're feeling now is just like a complete acceleration of things. And then you layer on AI and these technological advancements that are happening at the same time. And I think that's why people are just kind of like almost like shook a little, like shell shocked a little bit about everything that's happening. I mean, me and you watch the markets every day, right? Where it's 24/7 with Bitcoin. We've been following this. And even I am just like, wow, there's just so much happening every single week. There's a development where you're just like, wow, like that's insane. That's an insane development. So I think the uncertainty really started happening. And you kind of see that with, the first divergence that I talked about was how the Fed's been cutting rates, since September 2024. Typically what you see in a normal easing cycle is the long end start to follow the short rate expectations. But you haven't been seeing that. You've seen the yield curve steepen. Long rates have actually risen during that time, or they're staying sticky. And that's like pretty abnormal. And so what that tells you is like you think about what drives long-term yields. Well, normally, like I said, it's like expected path of short-term rates, but they're not following that anymore. So that's not happening. That's not why they're sticky. The other thing is like people start to price in inflation expectations. But when you look at long-term inflation expectations, they're still pretty anchored around the Fed's target of 2%. They haven't gone crazy. So that can't really say that that's what's causing the long end to stay high. And then there's growth expectations. And some people will look at the productivity potential of AI and say, hey, we're having this boom and GDP's running hot. But that's pretty uneven across the economy. Like if you are on the other side of these large fiscal deficits, or you're on the other side of this huge amount of AX CapEx spending, then yeah, like you're having a good time. And if you're implementing AI in a smart way, then yeah, you're having big productivity gains. But that's not equally distributed right now. There's also a ton of information asymmetry around AI. And there's this K-shaped economy. Like now we're talking about like an underclass, overclass of AI users. And so what I'm trying to say is we don't have like a classic growth boom yet. There's a lot of potential, but like that we're not really seeing it spread across evenly across the entire economy. And so again, that's probably not what's causing the long end to stay high either. And so the way it works after you kind of take out the short-term rates, growth expectations, inflation expectations, the residual, you could say it's related to the term premium. And the term premium is basically a word that's saying, hey, investors have to park their capital for, say, 10 years if they buy a treasury bond, and they're demanding more compensation for all the risk associated with that. They no longer view long duration debt as risk free, sovereign debt. And the US sovereign debt, the risk free rate is no longer risk free. They demand higher compensation because in this period of uncertainty, so much more can happen in a 10-year time frame. Wars, recessions, fiscal crises, anything could happen over 10 years. And after the global financial crisis, we were in this period of there was huge central bank buying with QE. There was a lot of rush to like safe collateral. People were scared. And so that caused a lot of demand for like quote unquote risk free treasury bonds. And so we were in that period of like low inflation, artificially low interest rates, and that kind of kept the term premium even negative at some points. But that's changed now. And now investors are basically saying like, if you want me to buy this debt for 10 years, I demand higher because there's so much uncertainty. And so that was like one of the divergences that I see. And it's still really interesting. It's still happening now. You got Kevin Warsh coming in saying they're going to cut rates and stuff like that. And they're still, the 10 years still above 4 and hovering. And so I think that's like a really key signal and something to really keep an eye on.
Yeah, that makes a lot of sense. And I want to dive deeper, I guess, into that divergence and the other divergences that you mentioned in the article. But first, also, I want to think about like this rising uncertainty that we're seeing and accelerating, as you pointed out. Is this going to be over, at a certain point, or is this going to be like a, high uncertainty perhaps for a pretty significant amount of time?
Well, I think it's going to last a little while. I think I believe in like the foreturning. I think we're seeing a real shift away from our like traditional institutions, lack of trust in institutions. I think there's no fix in sight for the fiscal situation. And I think you're going to continue to see uncertainty when it comes to the Fed and how they react to the long end. If we're going to see this Fed Treasury Accord, Kevin Warsh is coming in, and there's actually reasons to maybe be optimistic about having a younger, more, um, a different mindset going into the Federal Reserve, who thinks differently and who has a markets background tied with a treasury secretary like Bessent, who also has a markets background. And they deeply understand, I think, some of the things that are going on, and perhaps they could fix things, but there's uncertainty around that. And so I think you're going to continue to see a lot of uncertainty. And in that period, this is why diversification is so important. And you start to think about like, what do you want to hold for the long term, like a long duration asset for long duration savings? And if you can't trust or you don't want to trust any single uh, country, any single sovereign, you don't want to buy the debt of any single corporation. You don't know how this disruptive technology is going to impact each sector, let alone each company in that sector. If the management team's taking things seriously in this period of substantial change and uncertainty. And so what do you want to own? For the next 10, 20 years. And, I think you and I both agree that both Bitcoin and gold and sound monies, they remove risk, right? They remove counterparty risk and censorship risk and all business risks, management risk, sector risk, duration risk, right? And so like all these things make those assets attractive. And so I think when you're in these periods of uncertainty, you're going to continue to see tailwinds for alternative monetary assets that remove and eliminate some of those risks. to help diversify a portfolio. So I think we're in this uncertainty for a long time. And, when I think about Bitcoin too, I love Bitcoin because it is so certain. It's such a rare thing to have something that is certain in this world, like, period. Everything's so changing. And I don't think people appreciate, there's memes like 1 Bitcoin equals 1 Bitcoin. And I shared like my favorite meme at the end of this piece is that it shows the world and it's ever changing and it's chaotic. But then Bitcoin's like a signal that's just every around 10 minutes, there's a block mined and it's the same thing. And it just goes on like a ticking metronome. And that stability in that protocol is so cool to me. Like it's so rare. And so I think more and more people will wake up to that fact because right now it's like Bitcoin's price volatility disguises that underlying protocol stability. But as the world continues to feel chaotic and unchanging, I think people will start to understand that Bitcoin's actually one of the most stable or networks, protocols, technologies, and then assets that you can have exposure to.
Yeah, I completely agree that Bitcoin's extreme lack of uncertainty makes it a pretty compelling, you know, investment thesis for the coming decades. On your divergence point number one, I wanted to ask you. It makes perfect sense what you're outlining. Is there a scenario where the long duration, like treasuries, like 10-year treasury, actually yields actually come down like significantly, or no, like that's going to be pretty hard to do that over any serious amount of time.
Yeah, I mean, there's a lot of different scenarios. I mean, both organic and inorganic, I guess I could say. So, I mean, the organic way that long term yields would come down is that there is this like deflationary impulse, right? This concerns about AI are real from a deflationary standpoint. And in that scenario, you could see yields fall because technology is deflationary by nature, and it becomes a problem, like a potential deflationary bust, when you have the deflationary effects of technology with an over leveraged credit based system that requires inflation to stay afloat. And so, in that scenario, and if there's a lot of fear about a recession, you could see the long end start to come down. And then in that scenario, perhaps people revert to looking at it as the safe haven asset. You could also see a flood to safe haven assets, and maybe people still view treasury bonds to an extent. And so you could get some demand there, and you can get yields starting to fall as people go risk off. So that's one scenario. The other scenario is that we have curve control situation where they just keep the Federal Reserve starts to buy the long end, starts to monetize the debt, try to control the long end yields if they start to rise, and then you could start to see the yields start to come down on that end. But obviously, in that scenario, what's happening is debt monetization of the fiscal deficits, and it's the currency that suffers. It's the release valve there. And so, yeah, there are scenarios where that divergence could start to revert, and it could follow the short term rates. Also, if Warsh comes in and cuts big, like I'm talking like 100 basis points, like just goes heavy with the cuts, it would be kind of crazy to me if you don't see at least um, some pressure on the long end to come down a little bit in that scenario. If it doesn't, then that's even a crazier signal of how much the term premium is impacting the long end. So yeah, there's many scenarios where I could see the long end falling. But on the flip side, you could see it rising too because of the fiscal concerns. Like even the CBO just brought up projections, and once again, the deficit's projected to be higher this year than last year. And we know the structural nature of these fiscal deficits show that they continue to increase. And then if we have foreign investors not buying as much treasury bonds, and they don't do yield curve control, and there's more concerns about inflation, like you could see that go up. And then in that scenario, that's when things start to get wobbly from a sustainability of the treasury issuance that you're seeing, the fiscal deficits and all that. So they can go both ways. But right now, I think they're just screaming that, like, hey, um, there is actually real concerns about like what we're looking at when we crunch the numbers with the fiscal situation.
Hmm.
And we're not seeing any kind of austerity or cutback in spending. It's actually the opposite, seeing it rise. And investors are starting to just demand more. And so, um, yeah, that was kind of a long winded answer, but yeah, I could definitely see them going down in a certain deflationary impulse scenario.
Yeah. And so I guess like in all of those scenarios, do you see it being like, at best holding like a 10-year treasury being like a good, like a short-term trade? Like, is there any scenario where, holding long duration treasuries actually is like a good long-term trade? And the yield curve control example you mentioned, like it seems pretty obvious to me, like gold or Bitcoin would probably do a lot better, in that scenario, even if,
Yeah.
yields go down and bond prices go up. Um, but in the AI scenario, it's like, I saw this tweet that said, maybe perhaps TLT, which is like an ETF that holds like long duration treasuries, is the best AI trade. Debatable, I guess, of why that would be the case. But is there any scenario where long duration treasuries actually turn out to be a pretty good trade?
I mean, I think your last word is the key part of that, right? It would be a trade.
Mm,
And it's kind of like picking up pennies in front of a steamroller. And so, yeah, I mean, if you actually strongly believe that there is going to be a recession, there is going to be a deflationary bust, uh, driven by some of these AI dynamics, if it starts to show up in the labor market, yeah, you could get a trade there where long end yields start to fall. But you don't want to sit there, right? Because even like then, you're losing in real terms. There's no way over 10 years that coupon is going to outperform the rate of monetary inflation, especially in that scenario. Because in that scenario, what you're betting on also is that they're not going to come in and try to quote unquote fix things. And then I think that's the thing that Bitcoiners understand is we're kind of seeing a couple moves ahead. And even if we see that things are going to get messy a little bit because of the AI disruption and there might be a deflationary impulse, the problem is that we know that the behavior and the knee jerk reaction from the government and the central bank is to come in and try to fix things, try to manage and try to smooth out the cycle and not allow creative destruction to happen. And so, when I talk about yield curve control or debt monetization, return to QE, um, the behavior's there. And I think it shows like in 2023 with the bank crisis, after everything we went through with COVID, we had the balance sheet sky high, we had inflation run up after those accommodative policies were enacted. They just immediately, it was like immediately came in at the slightest turmoil in the banking industry and tried to save everything. And you could say like they were successful with their, what they did to kind of calm things down. But it's the reaction itself is the signal that they feel the need to come in. And so if we do have some kind of large recession from AI or some deflation, it's my bet that they will come in and try to manage things. And so you will see, this is what Larry Lepard says, the big print, but you will see a more accommodative Federal Reserve. You will see cries from people who, as the unemployment rate rises, for stimmy checks because the Pandora's, it's out of the box with all that stuff. People have gotten it before, they'll expect it again. And so I think Bitcoiners kind of see through that. And I think Bitcoin's actually the cleanest way to play AI in some ways for two reasons. Like one is that it's very clear that AI agents are showing you that they'll likely choose a digitally native money that's permissionless, that settles with finality without any trusted third party. I think if you ask any AI, you know, LLM, you'll say what money is AI agents going to use? Every time I've asked that, Bitcoin's been number one. And so I think that's one way to directly play the trend is Bitcoin. And then the second one is the expected monetary or fiscal response from any kind of deflationary. Bitcoin kind of plays both of them. And so in a way, I think it's actually a clean way to get exposure to the AI trend without picking, one hyperscaler or one company. you can just buy the Bitcoin and sit on it, and then you've protected yourself from the response that will likely be currency debasement and inflationary, as well as the trend because AI is gonna want more Bitcoin, and there's only so much Bitcoin in the world. So that's at least how I'm reading things.
Yeah, no, that is definitely very reasonable. I want to get into your second divergence, talking about gold rising. Obviously, gold and silver have been on an absolute tear. Just thinking back over the last 12 to 18 months. How does this tie into the idea of uncertainty increasing?
Yes, really, for a long, long time, gold has had a close relationship with real yields, and because gold is a non-yielding asset, and so when real yields rise, there's an opportunity cost to hold gold versus, say, short-term T-bills. And so I shared the chart because it's like the inverted yields versus gold, and you saw that even despite real yields rising, really since like 2023, gold is just like completely decoupled. It's like it's this move in gold to these new all-time highs. It shows that it's not driven by rates. It's not driven by like an opportunity cost. And investors don't care. They're like, okay, it really is are going up. So what? I still want gold. And why is that? Well, it's because again, it's like what we were talking about. They're demanding compensation for long duration. And the gold move is being driven not by rates, but by reducing risks of seizure, sanctions, concerns about currency debasement, long term fiscal sustainability. That's the bid behind the gold. It's not a rate story. Because if it was, then gold would likely be struggling in this environment with real yields rising. And that kind of matches with what we're seeing on the central bank side. I already brought it up, the historic rate of central bank buying. They don't care about the rates. They're buying it to diversify their reserves. And so, as I mentioned before, gold isn't anybody else's liability. There's reasons why it's why a central bank or a large financial institution would want to own some gold for diversification purposes. Um, but it's like gold isn't. It's not that it's ignoring the real yields, is what I said. It's that it's responding to the reason that they're likely rising in the first place, which is what I was saying before, which is like rising uncertainty. The term premium is rising, and that's actually beneficial for gold too, because in an uncertain environment, you want to diversify into assets and alternative monetary assets that are apolitical, neutral, don't have counterparty risk. Um, and so I think it's one and two of the same. You see gold's performance in a rising real yield environment with a rising term premium kind of point to the same thing, which is just rising uncertainty and investors repositioning as a result of that uncertainty.
Do you have an idea of how much incremental new capital is actually flowing into gold? Like you mentioned, central banks obviously have been purchasing gold around the world. But you look at, from what I've seen, you look at gold ETFs, pretty small in comparison, especially in comparison to Bitcoin ETFs. And then even if, from what I've seen, like if you look at the chart of like central bank holdings of gold compared to treasuries, I haven't done the math specifically, but it looks like a lot of the increase in the rise of gold holdings is potentially just like the price of gold going up in of itself. So do you have any idea of like how much incremental new capital is going into gold, considering gold's like a 30 to 40 trillion dollar, asset class?
Well, I mean, your short answer, I think, is a lot, to be honest with you, because I mean, gold basically doubled in market cap. That's one of the crazier things. Everybody who talked about how Bitcoin, couldn't reach these levels, or you're going to have diminishing returns as it gets larger. I'm like, yeah, maybe, but look at what gold just did. It's when there's a substantial demand for a scarce asset, you can get these price moves. And what, just to answer your question, like I think a couple of years ago, I'm trying to think about who shared this. Um, but it basically showed how underallocated institutional investors were to gold. I mean, it was like a crazy small amount of people had any exposure to gold a couple of years ago, which was mind boggling to me, given even back then it was becoming clear about these risks that now people are talking about the debasement trade. Obviously, Bitcoiners have been talking about that for a decade plus now. And it seemed like people really starting to wake up to that. So I do think a lot of like RIAs, institutional investors are starting to allocate to gold because they were crazy underallocated as of only like 2 years ago. And you saw like I think there was a maybe it was Bank of America or Goldman Sachs showed that gold was like the most overtraded or overweighted trade last year. It was extremely popular. And then you saw like anecdotal like Costco gold bars, remember those or like gold lines. So I think there is some retail, like anything else, number go up and there's FOMO and, like I had all these people talking about silver and gold, family friends and things like that. So I think there's some retail demand for it too as the price ran like anything else. I mean, you look at the silver chart, it's like a classic parabolic move. Um, and you kind of knew that was coming down just because it's like physics. Like, it can't just keep going up straight up to the sky. And so I do think there's like pretty substantial incremental demand for gold just because they were so out of position a couple years ago. And even back then, the risks were very evident of why gold might be an attractive place to be. Um, yeah.
I want to ask you about the third divergence, kind of now getting closer to Bitcoin. What's the third divergence, and like how does what are you thinking there?
Yeah, this one was like it was the divergence between global M2 and Bitcoin, and people were talked about that a lot. And Lynn Alden and I wrote that piece about it a while ago, and I even got chatter like oh, this is broken, you guys were wrong. But it's obvious that they didn't read our piece because we had an entire section about why that relationship decouples sometimes. And it was really a couple reasons. One was when there's idiosyncratic events within the Bitcoin or crypto industry that influence the price more than global liquidity conditions. Bitcoin is usually the purest barometer of liquidity. And it makes sense. It's like a mirror for irresponsible fiscal and monetary policy or currency debasement. It's a fixed supply asset. It's scarce. It's still seen as a risk asset, which even makes it more correlated to like pro liquidity versus taking liquidity out of the system rather than gold. And if you think about that, it makes sense, right? Because like gold still is a familiar safe haven. So when liquidity comes out of the system, people will rush to gold a little bit. But since most people view Bitcoin still as a risk asset, Bitcoin just like is very closely tied to liquidity. When it pulls out and people get scared, people unfortunately sell the Bitcoin because it's 24/7 liquid. And so, but in these periods where like, FTX collapse, for instance, or even a good scenario like the ETFs getting launched, those are industry specific events that have really become the main driver temporarily of Bitcoin's price action, regardless of what's going on with interest rates or monetary policy or Fed policy. Um, and so, in what we experienced in October 10th, we really saw this like large liquidation event happen across really the crypto industry, but Bitcoin got tied up into all that. And ever since then, you can see it in the liquidity metrics in the industry itself, like the exchange volumes and things like that, as well as sentiment is not the same. And you saw like Bitcoin decouple from other risk on assets, like the NASDAQ, for instance, just right at 1010, it just completely decouples. And just from talking to builders in the industry, like we had to recover from that. It takes time for that to get digested, for the sentiment to come back. And again, it didn't matter what was happening with liquidity. It didn't matter that the Fed was cutting rates or 85% of central banks were cutting rates or that they're, stopping their QT or things like that. Those are all positive long term, but there was things happening in Bitcoin industry itself that overrided any of that. And so we're seeing that like decoupling happen. And, some people would say like that's a sign of rising uncertainty too, because perhaps Bitcoin's acting as a leading indicator and that, we are about to see this recession and this deflationary impulse and that global liquidity is going to come down to Bitcoin. But I just don't think that's happening because of all the reasons I just said. Like the liquidity dynamics are improving or set to improve given the commentary from the new potentially new incoming Fed Chair Warsh about to cut rates, stopping QT, this Treasury Accord. I mean, the fiscal deficits are going to continue. They're actually getting larger. Like these are all positive for liquidity. And so I don't think this is, I was just saying, like people think this is connected to the rise in certainty, but I actually push back on that. I think eventually liquidity is going to take the wheel again once we can kind of work through some of these internal dynamics happening in the market. And just real quick, the other thing is like I talk about liquidity, it's more on the demand side of things, but then the supply side dynamics could also override anything happening with liquidity. Meaning, we talked about like the long term holders starting to take profits. That's been a big topic over the last 6 months or so. Um, but recently, we've seen that kind of change, right? Now they're starting to be net buyers finally after a deep period of selling. And so again, that's probably like turning. And so I think that divergence is less structural in nature. I think that relationship is still intact. I think we've seen this before where it diverges from global M2 and global liquidity conditions. But I think everything points to them injecting liquidity just generally to keep the system afloat. And then if we get this huge deflationary bust, then it's going to be like coming in hard to kind of fix the day, kind of like what I was saying before. And so that divergence, I think, is temporary in nature.
Is there any credibility to like these speculative rumors that I've heard about, a certain crypto exchange like perhaps being insolvent or, doesn't have the Bitcoin or assets that they claim they have, possibly related to the October 10th event, or is that likely just, complete noise?
I think, look, basically, an exchange is supposed to keep, 1 to 1 with their clients' assets at all times. They're not supposed to be doing anything. So really, what you're asking if they're doing anything bad or like kind of fraudulent, which is really difficult to say. It's like almost impossible to know if like somebody's a fraudulent actor. I hope not. And from what I would say from my conversations, as well as I know a lot of people who run um, quant strategies and who have algorithms that really had they built over time, especially in the aftermath of FTX, that look for certain things in exchanges and they trigger and flag to get them to withdraw their funds, right, to try to protect their capital from these exchanges. And I talked to multiple firms, and they're not concerned about a major exchange blowing up right now. I think where we could see trouble is where even recently we saw the fills news, which is kind of like a mid-size lender halt withdrawals. There might be some contagion from that. We'll see if they say it's temporary, but we've kind of seen this story before during the crypto contagion of 2022. If they weren't underwriting well or they re-hypothecating into risky things, that can be a problem. And that's why there's always risks. Not every one lender is equal. And so if we'll see contagion from that, I think that's more likely where we'll see it though, is like if there's lenders out there that were doing risky things, rehypothecating, I don't know if the risk is at the exchange level. I hope not. But that's not what I'm hearing from the firms that have systems in place to try to detect those things.
So if we do see global liquidity, start to expand again, and Bitcoin kind of starts to get back on that global liquidity train, do you expect Bitcoin to like catch up after this kind of like, the reason it fell was perhaps had nothing to do with the global liquidity, as you're pointing out, or do you see it like this is kind of like a permanent kind of quote unquote setback, and we'll just kind of ride global liquidity for here rather than Bitcoin starts like trying to correct to where it maybe should be?
Well, I think, look, these are like, it's like a long term relationship. And, I can't foresee if we're out of the woods in terms of the industry specific events. Like there could be more bodies that float to the surface. There could be more fear. Like we see the fear and greed at like the lowest levels, right? And so that could be still be the main driver of Bitcoin's short-term price action. Maybe we're out of it though. Maybe we're out of the woods and liquidity will start to matter more. Um, I think eventually, I think you and I both know that Bitcoin can change like that. Like Bitcoin has this way of like shooting up, right? That's literally how the price action works. That's why holding feels so painful, is because most of the time it's going sideways or down. And then it has these elevator up moments. And so when you say, can it catch up? I'm like, yeah, like I've seen it before many, many times where Bitcoin will just, when people least expect it, will just rip for like 2 months straight and reverse all the losses that everyone was, pulling their hair out about over the last 6 months. It could reverse it in like 3 weeks. I don't know if that will happen, but it wouldn't surprise me. It just big. I've seen it before. I've seen Bitcoin behave like that before, especially if we're talking about some kind of announcement from the Fed or Treasury that puts more concerns about the fiscal situation and how they're going to try to manage that, and if there's more risk of currency debasement. Things can change on a dime in this environment of rising uncertainty. That's why it's uncertain. Like people, you don't know if there's going to be an announcement tomorrow that's going to change the trajectory of not just Bitcoin, every single asset class across the markets. That's why there's such like it's a challenging environment for investors. But I do think over the long period of time, liquidity is the main driver of Bitcoin. And, I think that's a good thing, because basically when you crunch the numbers and do the math, it seems likely that they're going to choose to inject liquidity eventually, which is just increasing the monetary units, which is just currency debasement. And, that's why I think that's the fundamental value proposition of Bitcoin, or a structural tailwind of Bitcoin, or secular tailwind of Bitcoin that's not changing anytime soon. That was like my pushback. It's not the debasement trade. This is a secular trend that's not going to stop. Just because Bitcoin's dropped, it doesn't mean it's failed at the debasement trade. People need to understand that it's a long term play with Bitcoin.
Hmm. We've touched on this a little bit, but any other additional thoughts on the fourth divergence in your piece, where you're obviously talking about gold, outperforming Bitcoin for now?
Yeah, I just think yeah, I mean, I have a lot of thoughts about it. People are just saying like Bitcoin's failed as a safe haven now. It's just, quite frankly, I just think it's ridiculous. Um, Nothing's changed about Bitcoin at all. In fact, the fundamentals have only strengthened over the last 12 months in a way that like I've never even seen before, in terms of the regulatory clarity that we've gotten, hash rates exploding, institutional adoption. I mean, it's been a crazy ride over the last 12 months in terms of the fundamentals of Bitcoin, in terms of what are the odds that Bitcoin's going to be around 20 years from now. Those odds like spiked over the last 12 months. I mean, I thought of it before, but now it's like very clear, like Bitcoin's winning. It's going to be ingrained into the financial system. It's going to be seen as a pristine collateral, a pristine reserve asset, and so a treasury asset, the corporate adoption that we've seen, like all these things, Bitcoin's never been stronger. And now people are saying it's failed as a safe haven because of temporary outperformance from another safe haven asset. And I think with Bitcoin, the way I think about it is right now, the infrastructure and market, in the infrastructure and the market structure, it's still evolving. Like that doesn't exist in gold. Like gold has been around forever. Adoption is still growing with Bitcoin. People are still wrapping their heads around it. That doesn't exist with gold. You don't need any kind of incremental infrastructure changes. You don't need more services and products. You don't need the banks, you know, approving access to the asset class with gold. Like none of those things exist. So Bitcoin is in this period of growing adoption, emerging as a store of value, and it's still stuck in this like risk on regime, even though it has safe haven characteristics, and the market's still waking up to that. And so it makes sense to me that in the short term, gold, might outperform Bitcoin in periods of stress because Bitcoin still trades like this like high beta liquidity asset. But, over the medium to long term, Bitcoin's thesis is tied to what I was talking about, the monetary credibility, the fiscal situation, currency debasement, and all these different data points that I've talked about point to more uncertainty and more concerns about those very things. And when it comes down to it, Bitcoin is a bet that it's better technology than gold. It's why the quote, the future is here, it's just not evenly distributed. Because Bitcoin is digital, right? The two major things that Bitcoin has over gold is Bitcoin's digital. So it solves a lot of the physical issues that gold has that makes it prone to centralization and seizure. And it's expensive to move, all those things you know about, right? So the digital nature of Bitcoin and then the fixed supply. You know, there's nothing else like it. Even now with gold's price rising, you're seeing reports of how much increased production and investments happening on the gold mining side. And people don't understand that the inflation rate of gold being 1.7%, how damaging that is to purchasing power over long periods of time. It's like you lose half your purchasing power in 35 years, roughly. Bitcoin inflation rates around, 0.8% right now. And then it's declining over time on a set schedule to zero. And how powerful that is and how much better of a long-term store value that makes Bitcoin. And that's the bet. That's the bet. Like I said before, I would own gold if Bitcoin didn't exist. But because Bitcoin exists, and I think it's better technology for those two reasons and many other more, but those two reasons specifically, I think Bitcoin over long periods of time will outperform gold. And especially right now, given how small Bitcoin is relative to gold and how much more adoption still needs to occur. And that's why there's opportunity. It's like being early to a technology is kind of a double edged sword because it means there's a ton of asymmetric upside. But you also have to be patient and watch the world kind of stumble over itself, trying to figure out this thing, learn about this thing, choose other, what I would say, inferior options to this thing. You have to just wait and be patient for the world to realize what you know. And that's why there's an opportunity, but it can be kind of frustrating, right? And so, like, I think being early technology is exciting. And that's why education is so key. And that's
Mhm.
why I think that's why we both do what we do, just trying to teach people these things because eventually better technologies like win out, in my opinion. Like it's as simple as that. I think, and I think Bitcoin's no different than, the car and the horse, the electricity or candle. It's the same thing.
Yeah, I think that's definitely pretty spot on. You brought up market sentiment earlier, and you talked about how, like, currently, the fear greed index per se is like at record low levels for Bitcoin. I'm curious, like, I think you and I probably became interested in Bitcoin around the same time. For me, it was 2017, like that bull
Yeah.
market. Um, like, how do you gauge Bitcoin market sentiment at this moment? Like from my perspective, I think like the most trying times were probably like the 2018, 2019, like bottom around 3K. March 2020 when Bitcoin like wicked down to 3K, that was pretty crazy. Bottom of 2022 was pretty intense too. Now it's like pretty bad, but I don't know if it's comparable necessarily to any of those. I'm curious, like, where do you sit on current true market sentiment?
Well, I was always kind of baffled by it. Like as of like a month ago, I was like, Bitcoin was down, I don't know, 30% at the time or something like that. And everyone was like, the sentiment's worse than 2022 and 2018. And I was like, no way. Like, no way. Because I was there and it was bleaker. Um, I bring up, especially like 2018, I'm just, Bitcoin was so much weaker back then in many, many ways, right? There's just so much that it was such an uphill battle at that time. And it was down 80% plus, and now we're down like around 50%. And I think about, like, I like the movie Gladiator. It's like one of my favorite movies. And like there's a line in Gladiator from Marcus Aurelius, and he's like, there was a dream that was once Rome. You could only whisper it, like anything more than a whisper, and it would vanish. And it was so fragile. And that's what Bitcoin was in like 2018 in many ways, in like 2022. And we're so much stronger now. And so it's hard to me to understand how the sentiment's the same. But now after this latest drop, like it does kind of feel the same. I don't feel it myself and I don't really agree with it, but it feels the sentiments about as bad as it was then. And trying to understand why, I think it's a few things. I think there's a lot of expectations. I think it's painful when there's relative outperformance elsewhere. There's all these other exciting things making all these returns, and there's these expectations that Bitcoin should be at a certain place, and it's not. And so I think that contributed to the sentiment. It's not really like the drawdown itself. It's shallower. It's more about like it should be higher, right? Which is kind of a sign of impatience, in my opinion, because nothing's really changed about Bitcoin. I think the other part of the sentiment is around, this is supposed to be the perfect environment for Bitcoin in many ways, but it's kind of flat. It was like flat on the year. And again, I think it's just like a timing thing of like, if the environment's perfect for Bitcoin, like you should probably think about, acquiring some Bitcoin at discount prices. that's, that's what I think. I think it's just a matter of time horizon. And I've said before that the difficult part about being a Bitcoiner isn't so much managing the volatility because you've learned what you own, you're used to it after since 2017. It's really dealing with the high time preference of the fiat world around you and how they can't seem to think past like one quarter or even a year. That's such a short time frame in investing, especially in like the institutional investment world. Like a short time frame is like 3 to 5 years in that world, like a pension fund, you know, and so Bitcoin allows you to have a low time preference and you got to think long term. And I think people struggle with that. And specifically maybe a lot of the people who got in recently and with the ETFs and better accessibility, perhaps this is their first time really dealing with like major volatility in Bitcoin. But Bitcoin's a 45 vol asset, which means it can go in a given year, it can go up or down 45%. It's pretty much right on that. So it's very statistically normal for this correction. Um, so I guess what I'm trying to say is this: I think the sentiment is about the same. I just I just really disagree with it. I was there before, and not only was the drawdown much more extreme, but there was a lot of chaos in 2022. There was just like blowups everywhere. It was very tumultuous and intense, like you said. And then 2018 was just like so early, and there was so much apathy, and just like Bitcoin was still very fringe. And so I understood why the sentiment was bad in those scenarios. This one, not so much. Uh, and that's just my personal opinion. But what do you think? I'm curious what you think.
Yeah, it's an interesting point. I mean, I agree that like the drawdown for this one has clearly not been as bad as the previous drawdowns, but I think what has hurt so many people has been the relative performance of S&P 500 and
Yeah.
gold. It's like, and you know, Bitcoiners have been talking about the debasement trade and the correlation to global M2 for so long, and it's like it feels like the thesis has been correct, but the price is like disagreeing with the thesis, even though I think a lot of the things that we've expected to happen have happened. So I think that that's probably what's weighing on people the most. But I
Yeah.
think you
I
make
agree.
like great points in the article that kind of highlight like this is like a temporary issue, for reasons that have nothing really to do with global liquidity. Most likely, it might just be like crypto related type things, and it's just time time will pass, and Bitcoin will you know will resume doing what Bitcoin typically does.
Yeah, and I think Joe Wiesenthal
Yeah,
from Bloomberg. He's a Bitcoin critic. I like following him. I've followed him for a
yeah,
long time. He's kind of a funny guy. And Odd Lots has some good episodes sometimes, but very
Mm.
TradFi, very like, can critique Bitcoin, kind of uh give Bitcoiners some flack a little bit. But he wrote a piece that said like 10 reasons why this is the worst crypto winter ever, compared to like 2018 and 2022. And one of the things he said I just completely disagreed with. He's like, well, we're not early anymore. Bitcoin's mainstream. We got the ETFs, they got everything they wanted, so like it should be higher. That's why the sentiment's so bad. It's like we're not early anymore. How much upside is there? I completely reject that. Like it's like the institutional adoption that we've seen over the last 12 months was a big narrative. But it was like the warm up lap. Like it was exciting because it's the first time. But I would say the amount of institutional capital, which is like hundreds of trillions of dollars managed, um, is probably less than 1%, like definitely less than 1% of penetration. Um, and I think over the next quarter or two, one of the things that can help pull us out of this a little bit and help improve the sentiment is I think you're going to see filings come out of pretty impressive names and firms that have been buying this correction. Um, I actually there's a sovereign wealth fund this morning that increased their exposure over the last 3 months. Larry Fink said similar comments about 3 or 4 months ago. I'm seeing large sovereign wealth funds buying this dip. Robbie Mitchnig said, from their perspective of their ETF, I bet he's the head of digital assets at BlackRock for any listener who doesn't know, but he said that they're not seeing that at all. They're seeing a lot of interest and a lot of demand and buying and holding from their clients during this drawdown. And so I think that could be a catalyst to kind of improve sentiment, is just seeing that, okay, we're seeing this institutional adoption trend continue. And not only that, but they're showing some conviction in that they're holding their positions as well as increasing their positions, or they're allocating for the first time. And so I'm very curious to see the 13F filings for this quarter, or I guess the last quarter, and then the next quarters to come, to get an idea of how these new institutional investors are thinking about and behaving around this correction.
Yeah, it's a great point. Sam, this has been an awesome conversation. This is a great article. I'm glad we actually had some time to discuss it. Any final closing thoughts for the audience?
Closing thoughts. First off, thanks for having me. We didn't really get to talk like corporate treasuries or anything like that, but you can find out more about what I'm doing at Orange BTC. We're the largest Bitcoin treasury company in Latin America. We're listed in Brazil. And so you can go to orangebtc.com and check us out. Just learn a little bit about what we're building there. We're excited. Um, and I think my comments are really just, if I could summarize everything, I just always push people to focus on fundamentals and focus on the fiscal picture and focus on the risk of currency debasement. I sound like a broken record. I know I do. But you have to just keep bringing it back to that, because nothing's changed. And they can make it sound like things have changed and the price action might fluctuate, but there's really fundamental reasons why a absolute fixed supply, hard, scarce digital asset like Bitcoin is really could perform extremely well in an environment of rising geopolitical uncertainty and currency debasement. I mean, I just saw like a CBO projections. I'm looking at the fiscal stuff, and they estimate that 90% of the spending over the next 10 years is going to be Social Security, the care, and interest expense spent. And the problem is those are structural in nature, and you can't change demographics. And we're heading into a period over the next 4 years where it's called peak 65, which means we're going to go through the largest retirement wave in American history of people being eligible for Medicare and Social Security. And that's the when we talk about the fiscal deficits being structural, and just generally the fiscal deficits, it's basically Medicare and Social Security. There's no serious conversations occurring at the congressional level to change any of those things. And if the fiscal deficits continue to balloon, and that's not considering it some kind of war or recession that requires even more deficit spending, um, then we're going to continue to see inflationary pressures. We're going to continue to see pressures around the currency. And I just I believe with like one other thing. I saw this IMF report a couple months ago that really grabbed my attention. It looked at every single currency depreciation since 1971. And they specifically chose 1971 because obviously that's when we severed ties to any anchor with gold, and it's a free floating fiat currency. So they wanted to look at how have fiat currencies performed since we did that. And they studied over 160 countries, and they found that there was over 900 what they considered large currency depreciations since 1971. And they basically came away with like three takeaways. Let me just make sure. So the first one was currency depreciation remains as prevalent as ever. And so even over the last decade, there was 131 of these events across 20, and there's 24 countries registering two or more. That's over the last decade. And they said no matter how seemingly strong or stable a fiat currency is, it is not immune to large currency depreciations. And their last big takeaway in this IMF paper was there are few economic events that are as disruptive as a large currency devaluation. It sparks civil unrest, brings people below the poverty line, and it's completely destructive to an economy. And so if virtually no one is safe from this and no fiat currency is safe from this, it's imperative that people protect themselves. And I don't even care if it's gold. I don't even care. I mean, I really don't. Like, I don't view gold's rallying and gold's success as a invalidation of Bitcoin. I just see it as another safe haven, another life raft that people can go to because they have to protect themselves in this environment. And I think what that study shows is it just the track record of fiat currencies is one of wealth destruction and instability, and especially during periods of uncertainty. But like that's the track record since 1971 of fiat currencies: wealth destruction and instability. Bitcoin's track record since 2009 is one of wealth preservation, long-term wealth preservation, and stability, like what we talked about with the protocol. Like you have to think about the fundamentals in the protocol and then the environment that Bitcoin is in right now. And I'll leave it with that and just choose your money wisely. Choose your savings technology wisely.
I love it. I think that's a great spot to end it. Sam, thanks again. This was a great conversation.
Thanks, Joe. Thanks for having me. Anytime, man. And looking forward to seeing you at Strategy World next week.
Absolutely. I'll see you there.
Thanks.